Let's go through some of the economic data because, as we know, the Fed has been the kind of the driving force for the market. And the lower for about a year ago, maybe it's a little longer at this point, maybe a little less even. I had written an article, and it was called "The Fed's New Lower for Longer Lifestyle." It was on the, I think it was on Cramer's site. It was TheStreet.com or Real Money. I don't remember which one it was featured on. It might have been on both. I'm going to post the link to that in the description of the video on the YouTube rebroadcast, as well as on my Twitter stream, which I think you will find interesting. If you kind of get that, you'll understand the market. With regard to the data today, I took some notes. I also have the Bloomberg report here. The ADP employment number was a disappointment, and the prior reading was a revision down. So employment there isn't so good. Today's was actually a rather large miss. The prior reading was 177. The revision down was to 175. Today the consensus was for 170, and the actual was 154. So talk about missing by a country mile. Not a good ADP report. That's the private employment report. I find it's not so helpful with gauging the NFP, but people like to talk. The international trade. These are some of the. These are also, by the way, some of the themes that come up in the Fed minutes and the things that I've highlighted. So I know this might not sound so interesting, but it's important, and I want to give you guys the facts, guys and girls, the facts, and then I'm going to weave it together with my own unique blend to explain what the hell is going on here. International trade, the trade deficit grew. They were expecting a loss of 39 billion. It was actually 40.7. Not a good number. Yeah, so that was something the Fed had been highlighting that they thought was improving, and it's actually getting worse. The PMI service number today was actually good. The prior reading, by the way, was the lowest in the recovery, in all the years of the recovery, and today's number was better. I just want to take a quick look at. No, I'm sorry. That was the ISM non-manufacturing. The PMI though today was okay. August, by the way, was a 5-month low. So even with the rebound today, we're not quite out of the woods yet. Some of the internals of that PMI were not so good. It was slowing in new orders. So even though the number was a beat, the kind of the ground it's founded on is a bit of quicksand, sinking. And that's the lowest since May, the new orders. So that is not going well. Also, the hiring component in there is at a 3.5-month low. So the internals of the job number there were not so good. The pluses, I guess, internal, by the way, the input and the selling costs, meaning the inflation read for this, were subdued. So no inflation there. The positive was, though, that the backlog of orders kind of built. The factory orders, ex-aircraft, were a bit of a beat. The consensus was for minus 0.2. The actual was 0.2. But the revisions from the prior reading more than ate that up, went from 1.9 to 1.4. So not so great. The good part is, though, that ex-aircraft, it was okay. And there seems to be a bit of a rebound in business investment, which is something the Fed has been very concerned about, as have I. That's the short-termness of the nature of the situation. This has been going on for a long time. The Fed has mentioned that they don't understand why it's so bad. Obviously, it's clearly because of regulations. Now we get to kind of the all-star of the day. This was the ISM non-manufacturing index. This was good by all senses, by all measures of the word, for the most part. It was a big beat. Last month, though, was the lowest, like I said, lowest since the recovery, and the employment component in this was good. But most of these gains here happened late in the quarter. I have proposed for a while that the economy is not really in so much of an upswing, but we get these cyclical moves, kind of like business cycles, within a larger downtrend, kind of like a larger problem. So that is the economic data. Just another thing, some of the Fed heads have been popping off again. Charlie Evans, he was talking that inflation was starting to rear its head. And my kind of snide remark to that is that high-end strippers don't count in that reading. The inflation for the last 4 years has been below 2%, and the move up that he is referring to is from 1.4 in 2015 to, in the end of August, 1.7. That is still below the Fed's target of 2%. And the Fed should not, in my view, just get to 2% and then it's kind of, we know that the Yellen in her speech, and this is, remember when I turned, I had been bullish, then started getting very cautious, but on 4/12, that was the Yellen kind of come to Jesus moment, where she talked about, and this was the key word, allowing symmetry in the inflation data, meaning they've been off so wrong for so long with regard to inflation that they're willing to tolerate a bit more when it rears to kind of offset the time that there wasn't inflation. So to sum it up, to make a long story short here, and this could all potentially change a little bit, I guess the slant of it given the employment number on Friday. But it seems to me that the Fed doesn't want to step on the recovery. The recovery is kind of just starting. They would behoove themselves to be lower for longer. There is no trend in this data. The data is actually softening. Anyway, that's the Fed component here. Anyway, let's get into some of these stocks here that people want to talk about. Let me, where did I write that down? I wrote it here. All right, so today the mess du jour was in Salesforce.com, and that was based solely basically on the rumor that Twitter, they're going to buy Twitter, right? So Salesforce got smashed. There was really no, I guess, relief in that. I mean, it was basically a gap down. The stock has been down for a while. I know they're just finishing up their Dreamforce event. So what's my take on this? I think people are a little too quick to dismiss it and just say that it's only Twitter. Maybe there could be some kind of slowing in their business. Who knows? They're facing a lot of competition, we know, from Oracle and SAP and various other ones. I happen to believe that the cloud is doing really well, as exemplified by Amazon.com and their Amazon Web Services. But that being said, the stock is not doing well. This move down today was not the beginning of a move. I don't necessarily know, though, that it was the end of a move. If you look at the move yesterday, that basically took you out of a range, or started to take you out of a consolidation range, and then today was basically a gap and hold below. So where does Salesforce start becoming a buy, in my view? If you want to play right or right out for the gap fill, that would be clearly over the high of day, which was 69.60. However, I'd be more interested in this thing at the lower gap fill, down closer to 62s and near the trend in the 61.8% Fibonacci retracement, which come in around 64.78. So I'm thinking somewhere between 64.78 and 62.52. And the way I would handle that, since this is not a young move, and this is when, kind of the end of moves, both up and down, is when it gets the steepest, unsustainably steep. Like if something's been down for weeks and weeks and weeks, and finally it gets that crescendo move, that's when everyone is selling at the wrong time. So I'd be more interested in buying it sort of at the end, more like toward a little bit lower. I'd be interested in selling the puts. I think that would be the better way to do it. And I said online today, I got asked this question quite a bit. I think the thing that concerned me also was that people were really quick to want to buy Salesforce. They wanted to dismiss this. This has now spent 3 weeks now consolidating, with this week being a look above and fail below the 100-week MA. when 100-week MAs start failing, I start thinking 200-week MAs, and that's roughly around 61.30. By the time that the stock actually gets there, I can't tell you that it's not going to be roughly around that gap fill, 62.52. So everything is sort of lining up around that area, and that's where I'm a little bit more interested. I'd like to sell the out-of-the-money puts there. So yes, I'm starting to warm up to Salesforce, but I'd like it a bit lower. The aforementioned Twitter. So everyone is sort of speculating on Twitter where and will this thing have a bid, where will it not have a bid. I did a poll on it. I asked where this thing would wind up going out. Could it be mid-20s, mid-30s, mid-40s, or is it going to be a Yahoo 2.0, meaning there is no, there's never a bid, right? That it never happens. So I can't tell you that that will not be the case. My view on that is that there will either be a bid, and the bid will have to be substantially higher, and I've proposed that I think it has to be somewhere in the IPO range. I like 50% fibs for this kind of thing, which is 44.47. The breakdown really took place around 44.45. I'm sorry, 45.46. I think that they would need to be up there for the deal to go through. If not, I don't know that this is going to be an accepted deal, and this could be in the danger of the Yahoo situation. Stocks are high, right? I mean, the market's high. So I don't necessarily know that a company needs to come in and bid all cash for this stock. They can do a partial cash or an all stock purchase type of a deal. Companies with big stocks like Apple or Apple or Google or who knows? I mean, you name it, Microsoft, they can do some kind of a stock deal for Twitter. So I don't necessarily know that the deal doesn't get done, but I don't think that a deal will be acceptable to the average Joe if it's not something significantly higher. I mean, if you bought Twitter, in this area since this kind of deal started, are you really looking for, $28 or $29? I think 28 is roughly what the analysts are saying. They think the deal will be $20 billion. That's roughly about $28 a share. The breakdown in Twitter took place around 29.51-ish. So I don't know. I mean, I personally, I've been holding shares for a while here. Hopeful something like this would happen now that it's finally happening. But I wasn't really thinking for a move only back into the 20s or 30s. I wouldn't feel as rewarded on the risk that I've had on. I'm looking for, basically a double up back up to that level. So that's my take on the Twitter. Yeah, so Alibaba. I got inspired with Baba. So what's the scoop with the Baba? You have two kind of topping tails the last couple of weeks. I'll tell you, it often helps to look at these stocks. Sometimes we get caught up too much in the day-to-day, and I don't want to discount the daily bars. They are very, very important. But it's often good to take a step back and look at a bit of a longer-term perspective. And you do have some topping tails on the weekly. This week seems to be repairing a bit, but I'll tell you, if you get below the 2-week low here, which is 104.57, I think you want to be a GTFO. My upper target, a lot of people have been talking 120. I think it's possible. I've been saying for a while, I thought 110.49. We got really, really close in the 109s to close to 110. I think you had a couple of people who were jumping the gun, preemptively selling. Anything below 104s, in my view, puts the 103s all the way down to like 98s, possibly back in play. This is run a lot. I would actually like that pullback ahead of the earnings to maybe play long for the earnings. However, they blew it out. The last quarter was an absolute blowout, and these guys are basically Amazon of China. So if Amazon is kicking butt here, I don't think Baba is nearly as far along with their situation as Amazon, but I do think the same story could start playing out. So those are the levels I'm watching. I want to see if it can hold those weekly bars. The 104.57-ish is very important to hold. Below there starts getting a little, a little iffy to me. The aforementioned Amazon. I a lot of people will say, "Oh, who saw this coming?" Yeah, I had been saying I thought for a while Amazon would see the 833.91 1.618 Fibonacci extension from the 696.44 high to the 474 low. So where round and round she goes, where she stops, nobody knows. Actually, I think I have a little bit of color on that. So we got the 1.618 Fibonacci extension. In my view, you should be starting, if you haven't started to book the profits in this, don't be a pig. Sometimes you overshoot these levels, and then, I don't want to frighten anybody, but the last time Amazon had a major correction after a significant high, it was 222 points plus. That could happen again. Actually, I think it will happen at some point again, but where will Amazon potentially stop? So I've said that if the 1.618 Fibonacci extension doesn't quite do it, there is room for an overshoot up to 885.19. And by the time we get there, everyone's going to be saying 1,000. I don't know if it's getting there to 1,000 this go round or not, but I didn't just pick that number out of my hat. The last run where Amazon had this kind of a big move, it was $411.19, which started in the beginning of 2015 on 119, and it ended on 12/28, right after, I guess, the Christmas sales were Amazon whatever day. So yeah, I think that move was $411.19, and when you project that off of the 474 low up to the high, it's 885.19. So somewhere between 833.91, which we're through now, and 885.19 is the area to is the area to kind of cut the cord. So that's my my view on Amazon. Apple. So Apple is benefiting quite a bit from the kind of destruction of Samsung. The Galaxy Note is exploding again. They had to stop a flight, a Southwest airline flight, because of a replacement to the Note 7 now is catching fire. So they took back the original ones that were catching fire, and now they're issuing new ones that are catching fire. So that should be good. Apple wasn't really up much on that news. I'll keep it real simple with Apple. The breakout reference here was 112.39. As long as that holds, and like the most recent pullback low was 111.55. So as long as that 111.55-ish area, that's, by the way, on the weekly, a double bottom for the weekly. Is that the weekly candles? So as long as 111.55 holds, I think the play is to the upside, and the move would be to 119.75. Caveated with below 115 is a little squishy. So we really need to hold that 111.55. If you lose the 111.55, then I think we could easily retest the 109.85 and potentially back down to the 105.44, which would be a gap fill. So it's sort of 111.55 needs to hold. By the way, in the flash crash from like the Wayback Machine, the flash crash low, and I'm talking about from like, where was this? I'm trying to, it's been so long I don't even know where it is on my chart. This was on 8/3 of 14, that was 8/11/27. So these 111s are a big deal. Apple needs to hold the 111s for higher. I'll keep it that simple. And I apologize for the beeping going on in the background. My dishwasher here finished. That's how we be rolling over here. It's good to have a sense of humor. Netflix. All right, so I talked about Netflix. I've been saying this for weeks, that it was still vulnerable until it could clear the 200-day MA, and once it cleared is when you want to be long. I took my own trade, and the stock is doing really well. The gap fill is 108.40. I think somewhere in that 108.40 to 110.70 level will be the area to start booking the profits. They've been floating rumors around that Disney's looking to buy them, and this one and that one. I think this is complete insanity, of course, but I do like the idea that it's getting the move ahead of the earnings, which is on 10.17. I will, in all likelihood, be out of the stock when we get that gap fill area. I'm sure there'll be tons of chasing up there, and people won't realize that the stock has basically rallied from 84.50 all the way back up to fill the gap. And they will not be having the best trade location. So I think, unfortunately, a lot of this trade now has been missed, and you probably want to start looking to book the profits on the rallies. There is another gap fill I'm seeing back up at the 115s, but I'll probably be long gone by then. I'm only looking for the 108s to 110s. So that is the Netflix. The way I played that, by the way, was a call spread risk reversal. Like I sold some out of the money puts to, not fully, unfortunately, but partially fund a call spread. I think I did it a little too long and longer dated. I tend to do that sometimes. I don't like to be rushed. I'm just looking around my phone here. I did it in, actually I didn't do it that long. I did the, it's now 16 DTE. I did 103, 109 calls funded by short 93 puts. So yeah, that it's working. It's working okay. Could be better. The IV in that won't drop, of course, until the event, but hey, whatever. It's working. That was the end. That was Netflix. Tests. Let's just do Tesla. I already mentioned it, so we'll do it. I see people mentioning to me, by the way, on the stream, that this video, some people got cut off. I'm seeing some technical issues as well here in the broadcast. So this will be rebroadcast on my YouTube channel. By the way, if some people are in here still seeing this, if you could just type and let me know, that would be helpful. Tesla. All right, so the 200 MA was where it held after hours. I said that that would be resistance. You have a confluence of the 100, the 50, and the 200 MA. That has been the resistance. I think that there could be a move to the backside of the old up channel, which we, depending on when it happens, if it happened on earnings, that would be close to the 230s, which is roughly where it stalled the last time. So between here and the backside of the old up channel, which will be shown in the weekend review video it's actually in the weekend review video, so if you want to go back and watch this past Sunday's weekend review video, that will also be in the description of the link below, so probably want to check that one out as well. That's where I see the resistance being. The best play for me with this one, and I've talked about this, is to maybe sell some out of the money strangles. I think that the shorts are going to kind of wait on this one because they know there has to be a Solar City secondary to fund that deal. So that's what's been holding it back. Otherwise, I think this stock would have been much higher by now. That's my view on the Tesla. Taser. So this is one I've liked. They lost a bid to another company for the coveted New York bid. Taser usually comes in at about $40 a cam, and the other company underbid them for like $20. I believe this other company is not profitable at that price, but I think they wanted to kind of plant their flag and to get the contract, which they have succeeded in. That has caused a lot of fear about margins. And Taser has been down the last few days. 25s were a key level. We're below there. The next big level that I see are the 21s, and believe it or not, even down to close to 20, which is the 61.8 of the range. So we have a channel low coming in just below us in 22.44ish. You have the 200 MA at 21.80. So I think that this area here is going to be key. If it fails, and I do think it should hold here for at the very least a bounce, then maybe the 19s area. I'm going to start dipping the toe a bit more as we come down closer to that 200 and into that 61.8. So somewhere between the 21s and the 20 area, I'll be looking to sell some more some out of the money puts. That's my view on Taser. I think that market is huge. I think the fear, it might be a little bit overblown, at least short term. I had been long this and sold it at 30. It got a couple of ticks higher to 30.15, and then it's really never looked back. So I am looking to get back into this thing. So this is kind of where I'm going to start to dip the toe a bit. Yeah, Google. All right, so Google has been one of the only ones here that have not really been part. I mean, they had a big run from the lows in when was this, 627, and it's been running. It got to the old all-time highs, and it's just been consolidating. This thing ran from the low end of the range to the high end of range and consolidating. They report soon. I have thought for a while Google is going to see the 895.44, which is the 1.618 fib extension. It's also the channel high, and it would coincide with the earnings release. So if I had my druthers here, what I'd love to see is this thing actually pull back. I know it's really loved on Fast Money yesterday. Everyone on there was in love with Google. They liked it more than Amazon. That means that, to me, that I would like to see the stock disliked. I always love when stocks are hated going into their numbers rather than loved, but I do think that this stock is consolidated enough that it probably can see that fib extension. It's really not that expensive anymore based on their forward earnings. So I think we'll either see that move higher, or at the worst, this thing probably could fill the gap back down to somewhere between the 765 and maybe you get the 50% fib, 743. So it's like, maybe 50 down and 75 up or whatever. We'll see. I think let me look at the what the market maker move here is on Google for the earnings. October, this can't be it. Yeah, this one has it. As of now, the move into the earnings expiration is about 47.96. So interesting that I kind of knew that without even looking. That just comes with feel, by the way. When you've been doing this for a while, I always say it's like going to a bar, and a good bartender can eyeball it. They don't need the little measurer to measure out the liquor. When they start pulling out that measurer, I know to go to the other bartender. So that's my view with the stock. Baidu, not one I follow that often. Oddly, before Baidu, I mean, years ago, I had made a lot of money in Baidu. I really don't mess around with that stock that often, but when I do, I do, and I'm not currently. There's no trend in this. It's starting to make some higher highs. Higher lows. Minorly higher highs, and it is above one of the downtrends. It's into the 60. It's been into that a few times actually here. From the 100 low, I don't even remember what happened. It might have been the flash crash low. I probably should adjust this Fibonacci extension. Let's remove that. I think that I don't remember what happened. Was that a real price? Does anyone remember that? That seems a little odd to me. I think that feels a little flash crashes. Let's bring this down to the bounce low. 205 would be the area. It's gotten there a couple of times. Once a lower high. This is still a lower high. This is a really weird chart to me. I don't see an edge in this. Sometimes you just have to. Yeah, someone just said it was the flash crash. You can just tell those kind of things. I think that if this were to pull back, you have a lot of moving average confluence below this. You have a 50 that just crossed through the 200, and you have the 100 coming up and the 200. A lot of this, there's a lot of confluence down in the 170s. I would like a right or right out off that 100-day moving average. That's the lower of them. So somewhere in that area, if there was a move down, they have earnings coming up. China seems to be turning. It seems hard for me to believe that Baba is killing it and Baidu is not. So I'd be into buying this on a dip. I don't really want to chase, though. So that's the Baidu. Wells Fargo, another one that's been in the news. That CEO, I think his days are numbered. I think the risk in this one is down to like 39.40 to 40.07. I've showed that in the weekend review video. why that was significant, but I said I didn't know if we were going to do that in a straight shot. This was now a look below and fail in the range. I do think that this will bounce before that move lower, if anything. Listen, the worst of this could be over. The 44.5 is the key level. We had 1, 2, 3, 4 days below there, and today you took back a lot of it. If you can clear, in my view, 45, 48, this might be done with the decline. The ideal scenario, in my view, just thinking longer term, this would have now a minor bounce up and then come back through and make that move lower, because I am looking to buy Wells Fargo, but I want to buy it a little bit lower. It's roughly now the first time that it's closed over the 10-day MA in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. In almost over 2 weeks, so that could be the beginning of the end of the decline. 44.50, anything above there, I like it long. Back below, I think short. Keep it simple. Keep it simple. A lot of people. So what was working today in the market? The fear of clearly there's a fear of a rate hike coming in December. I think based on the economic data, the Fed should not go. That doesn't mean that they will go. I mean, they won't not go. I've said for a while, I think December is in play. As of right now, it's being priced in at 51.7%. So the market thinks that rates are going to rise in December. That was very evident to me in a few trades. One is the yield plays. We're getting smoked. That's the utilities, that's the REITs, so on and so forth. TLT has been down. And those yield equivalent plays, they were moving into today to growth. Financials and oil. Oil has been screaming ever since that issue with with OPEC potentially raising their cutting their production quotas. 49s to 51s is the resistance, so I don't think oil is going to be a straight shot through there. I think it's going to chop, but I do believe that the risk is probably to the upside at this point. We'll see how that goes. The Fed also follows oil, so that'll be important to see. So which move was the real move in the market? You know, I still think it's rather inconclusive what's happening here. I'll tell you why. Yesterday, everyone was in like this freak-out mode in the morning until about noon, a little after noon, and then it kind of just around 1-ish. I think that people just hadn't been so accustomed to 10-point ranges in every 15-minute bar, and when in doubt, palms out. So they sold. But the VIX wasn't higher, and the breath was rather mild. Today's breath also was rather mild. So I don't think we have any resolution. One good thing was today was that price closed over, and the VWAP was over yesterday's value area high. A couple of issues. RTH, we closed just... Did we? I have a lot of bars here. RTH, we closed just below the debate high in the 927 overnight high of 2154. In after hours, we closed slightly above it. You know, the market trades for 15 minutes after 4 o'clock. So we did technically, and now it's slightly below. Inconclusive in my view. I'll tell you this, the market needs to hold 2154 in the ES I'm talking Z6 terms now, and clear the Fed day high, which was 2157.5, which we had a look above and fail today. And then we kind of had that little bit of a sell into the close, although I think most people were playing long, and the must go home flat crowd kind of came into the picture. Yesterday we had tweezer tops at 2158 quarter. If we can get through there, and we probably should be able to get through there, the algos will want to run the stops higher. So above the 2-day high, I like long. If we were to get below today's low, then I think we're going to retest yesterday's low and probably go lower. Below yesterday's low is a right or right out short. it is also a poor low. Today had poor highs for a while. I believe they were repaired. Yes, they were repaired. We still have the poor low, though. Does that mean that the rally is over? Not necessarily, but usually when you have a poor low, there is the rejection before the repair. I don't want to guess. I want to play against yesterday's range. So we'll keep it simple. We're still below the downtrend. We're still below the 50 MA. We've had the look above and fail on Friday, and then yesterday was sort of the look below the consolidation triangle low. So yesterday's range, and then 50 MA. I think the bulls need to clear and close over the 50 MA to be on more terra firma. And below yesterday's low to me is a right or right out short. At the very least to the 100 MA, which is really right below it. I don't know if that would hold again, but I think we would traverse the entire range, then back down to the 212s, and then maybe even overshoot. If it breaks through there, I've said for a while, the next kind of stopping points would be 211 to 210, which was sort of the real true breakout range, another true breakout range. 209.53 is a gap fill, and if you double the range, and I'm talking about from the 219.60 high to the 212.31 low, and you project that $7.29 range down, that takes you into the 205s, which is very close to the 200 MA, which is currently around the 61.8 of the entire range, which is 206.65. So and that was also, by the way, a very key level back kind of in the day. It could always overshoot to the 203.20, which is a gap fill, and roughly the 678.6, but I would be bowling for 205s, 206s on a snap of that area, with a caveat, though, that there is a lot of other support levels below. 210 to 11 took a frickin' long time, and I almost used the F-bomb there to get through. I don't know that the market is just going to let that go so quickly. I think a lot of people are still very bearish and not believing it, and I think that they could be squeezed very easily if we get back up above the 2-day highs and the 50 MA. So that's what I'm looking for, either long over the 2-day high or short below yesterday's low. In SPY terms, that's what would be long over 216.17 and short below 213.99. Done. Nothing more to talk about with regard to that. TLT, which are the bonds, has been pulling back ahead of the Fed, as has gold. I haven't been talking a lot about gold, but I will after the TLT. Today we had a bit of a hammer low. This has been rather tame within, it's a down channel within an up channel. So short term, the trend has been down, but we're still within the confines and context of lower for longer move here. So what does that mean? If the Fed raises rates, this will not be a good situation. You have, though, a lot of reference support areas below. You have the 61.8, which held the last time. The 200 MA now is coming in close to it's 132.57. The last reference low was 133. That area is also this sort of more benign channel low. If you get to the big channel low, you're talking about getting close to that area in 132s roughly. So I think, and there's also a reference low, another reference low at 132.08. So I think this area here coming down a little bit more is going to be a big frickin' battleground. If that were to snap and you were to lose that, I think that this would be free fall to 127s. So we're going to see who's who in a little bit here with regard to rates. I think if this keeps going down into the Fed, it will be a long for the Fed. So this is going to be a Costanza, kind of like the entire market. If they dump it hard ahead of the Fed, it'll be a long, and if they ramp it hard ahead of the Fed, it'll probably be a short. Probably the same thing with the market too, oddly enough. NFP is going to be huge on Friday. Today was Wednesday. I don't expect a lot ahead of then. We'll see tomorrow. It could be more of this same chop, but like if you're along, I can't really. The shorts tend to be like true believers, right? Like Indiana Jones. So they might want to pile in, who knows, but I would be very leery of anything ahead of Friday. I really want to see that NFP. The algos are going to trade it. Everyone is going to want to trade that number. And yeah, I think that people are going to kind of be waiting to see the NFP number. I think that's held back a lot of the Q4 allocations. We just ended a quarter that kind of had a bit of a run into it, not too much, but a little bit. But all you need is a little bit, right? I'm getting some 50 cent in there. Have to quote 50. Anyway, I'm thinking that we're going to really be a little choppy and not have a definitive move until after the NFP move. And lower or choppy into that is safer than a ramp. So keep that in mind with longs. I teased this before. There seems to be a ton of confusion about MOC. What does the market on close mean, the imbalance? So let's start out with what market on close, when I tweet out, like, for example, MOC 600 million to buy, that does not mean buy the futures to play the game that people are going to ramp it for the close. Often when there is size, like 2, 3, 4, whatever billion, it's usually between 1 and 3, excuse me, and that's usually on quarterlies, it can be gamed sometimes. However, I don't use it that way, and the proper way to use it is this. Note the trend. Are there multiple days of buying or multiple days of selling? That is often a precursor to the bigger move coming in the next few days or few weeks. If you have multiple days and months of selling, it doesn't mean the institutions are loading up. It means they are selling. The vice versa. If there's multiple days of buying, there probably will be a move up. MOC is one particular type of order, market on close orders. That doesn't mean that there aren't limit or market orders that come in ahead or behind it to move the market. It's just one type of order, and it is a glimpse into what the big money does, because most retail traders don't use MOC orders. Big institutions do, because they want to mark their positions to the closing price of the day. Who thinks like that? Not you or I, the retail guys. Institutions do. Keep that in mind. One type of order, it doesn't necessarily mean that because there's a big MOC, the market has to go up. How I like to use it intraday is this. If I've been selling or buying stocks that day, or I'm looking for an exit, or I'm looking for a price move, let's say I'm close to a target, I like to see where the big money is, which way the wind is blowing with them. Are they looking to buy, or are they looking to sell? If I have stock to sell and I know that there is a huge, like I'm long and I have stock to sell and I know there's a big MOC to the buy side, I know that prices may have the wind at its back for a move higher, and I could sell my stock higher. If I know there's a huge MOC to the sell side, I might not wait until the end, where I know that there's going to be a lot of cascade of sellers, and sell it a little bit early. Same thing if I'm short. If I know there's like a 2 billion to buy MOC, I'm probably not going to keep the short until the last few minutes when those orders get executed. I'll take it earlier. But if I'm short and there's like a huge, like $2-3 billion, or 600 million or whatever to sell, I might want to press my luck a little bit and see if I can achieve my downside target. So that's the two ways to really look at MOC. To note the trend, and then to use it to kind of guide you with entries and exit of existing trades, not to try to game it itself. That's kind of a sucker's game in my view. Anyway, let's end it there. I'll cover more of this stuff. I didn't get to everything here. I wish I could have. But I think we're good for now. I will be doing a weekend review on Sunday that will cover the NFP and have a Fed update. I've been working on a thesis that I think will send some shivers up people's spines with regard to the Fed. I don't want to tip which way I'm thinking with the Fed there, but it's a big it could be quite a big statement. So I want to make sure I really get it right. Anyway, that's my story. I'm sticking to it. I know that this broadcast had some issues. It will be rebroadcast very shortly. I'm going to do it as soon as I get out of here. And it will be uploaded to my YouTube channel, which is Justin Pulitzer Trades. If you caught part of this or want to watch the whole thing, that's the place to do it. Also, subscribe to my YouTube channel and click the little bar there with the notifications so you get notifications when I post new videos. If you're not following me on Twitter, my handle is @JustinPulitzer. That's where the That's the stream that I often refer to, and I post daily updates on there. Anyhow, that's it. I will see you on Sunday. Cheers.